Balance sheet, income statement, and comprehensive income. Under the US GAAP, your general purpose financial statement is defined as a full set of financial statements and, of course, the notes to the financial statement. There are 5 components. A full set of financial statements typically include 5 components, namely statement of financial position, also called balance sheet, statement of earnings, called income statement, statement of comprehensive income, statement of cash flows, and statement of owner's equity. We are going to discuss each one of them in sufficient detail so as to cover everything and give you the complete syllabus coverage. So first, let's have a look at a balance sheet, how it is structured and what are the components, and then we'll discuss as we proceed. Assets are segregated into current and non-current. Within current assets, you have cash and cash equivalents, trading securities. At fair value, we'll discuss account receivables, net of allowances, note receivables, inventory, and prepayments. And in investment classification, we have available sales securities, held to maturity, investment in affiliates. And then in the long-lived assets, also called the property, plant, and equipment, or the fixed assets, we have land, building, equipment, goodwill, and patent, that is intangible, and other assets, that is pension and other post-retirement benefits, deferred income. We are going to discuss each one of them in detail in the coming sessions. And in the current liabilities, we have the liabilities which need to be settled within 1 year or operating cycle, whichever is longer. And long-term liabilities include bonds, deferred tax liabilities, pension obligations, and then we have stockholders' equity, consisting of preferred and common stock, and some other components of equity. Everything is coming in the subsequent classes. Income statement. What is the purpose of the income statement? I have structured my slides not showing you the points, rather questions. It is easier to remember what is asked and what is answered rather than just the bullet points. So this structuring would help you absorb the idea, remember points from viewpoints of questions, not just text for the sake of text or just bullet points for the sake of bullet points. It says, what is the purpose of income statement? You need to know. The income statement details how funds are used and generated in a business. It will show you expenses, losses, revenues, gains, which we will discuss in the next slide. What can the income statement tell us about a company? An income statement shows you the profitability of a business. It shows you operational efficiency and how it manages earnings and how it manages its expenses. Then it says, how is the income statement useful for future financial predictions? Yes, this is a very important question. It provides historical data that is essential for future forecasting, future cash flows, and of course, evaluating companies' financial stability. Various components of income statement. In the income statement, you will see costs, unexpired costs, revenues, expenses, gains, and losses. Let us discuss them briefly. What are costs and unexpired costs? Costs are amounts we have spent on items like acquiring assets, acquiring services. And what is an unexpired cost? The cost that is not yet used or the benefit of which has not yet been utilized. Consider you have paid insurance premium covering the current period 6 months. Maybe you paid on 1st of July up to next year 30th of June. So 6 months for the current period would be the cost for the current period, and the next 6 months payment which have been made in advance is unexpired cost. That is what you call the prepaid insurance or the insurance paid in advance. What are revenues? Revenues are the total money earned from goods or services, and of course these are just the earnings. We haven't yet deducted any expenses from them. What are expenses? I guess a key difference that you need to remember, revenues are central and ongoing. Some goods or services that you keep on selling as a part of your regular operation. And expenses are the costs incurred in the current period to generate revenues. So these are again recursive and repetitive. Revenues and expenses are central for ongoing business operations. Gains are incomes, but they are not central or ongoing. So there is a clear difference you need to remember between gain and revenue and expenses and losses. Revenues and expenses are central and ongoing, whereas gains and losses are not central, rather they are incidental. For example, any gain on disposal of old asset, any commission income earned, whereas our main business might be trading, so you may have earned some commission on a transaction, right? So certain gains and losses which are not central to our business activity. So what are gains? Gains are profits from the transaction not in the ordinary course of business, like selling a fixed asset for more than its book value. What are losses? Clearly, losses are the amount lost, such as from selling investments below their book value or losing assets without generating revenue. And these two are not central. They are just incidental, peripheral transactions. They have little occurrence, but revenues and expenses are central and ongoing, and they keep on repeating every period. Then we have multi-step and single-step income statement. Let's see. This is it. This is your multi-step income statement where you have sales, that's cost of sales, and this gives you gross profit. Then you deduct your selling and administrative expenses, you get your operating profit. Then you consider your revenues and gains, this gives you, and then you deduct your interest expense, any loss on sale of fixed assets, any restructuring expenses. This gives you income before taxes. Then you deduct tax, you get income from continuing operation, and then you have discontinued operation. We'll discuss this in the coming slides. So this is what you call the multi-step income statement, where you have different layers of profitability: gross profit, profit from operations, profit before tax, and finally the profit after tax. So this is called a multi-step income statement. So in a single step income statement, we make a shortcut. What we do, we add all our revenues, whether they are central or maybe just coincidental or peripheral, all revenues, sales revenue, service revenue, interest revenue, rental revenue, gain from sale of securities, gain on disposal, and other revenues, all revenues in one direction, in one place, and deduct all the expenses to get you a single figure for expenses. And this gives you the income from continuing operation. Then discontinued operations we'll discuss just a little while, and then you get the same net income as we got previously. So it's just a one-step arrangement where you have all the expenses and all revenues in one place to give you the net figure for the profit. Clearly, it's not a good option, not a good presentation, because as a manager, I would like to see my different levels of profitability: my operating profit, my gross profit, my trading profit, my profit from other activities, then income before taxes, and then of course net income. So this is not a very useful format. So what does a multi-step income statement report? It reports your operating revenue, your operating expenses, and they are shown separately from non-operating expenses or non-operating items. Then what is the benefit of multi-step income statement? I just told you it provides detailed data useful for calculating various levels of profitability, for calculating various analytical ratios. We will discuss this ratio analysis as well in the coming classes. What does a single step income statement include? Well, it combines all revenues in one place and expenses on the other, including income taxes, of course, and it does it in a single calculation. So what are the benefits of single step income statement? I would say only simplicity. It just offers a simple design and treats all types of revenues and expenses equally important. So that is just the only benefit of single step. Then we have a very important topic on discussion: discontinued operation. MSUB Incorporated is a food service company that delivers frozen food products to food service providers. Its clients include fast food restaurants, high-end steak houses, home delivery, diet food companies, and institutions such as schools and hospitals. Historically, the fast food restaurants have been the largest segment of MSUB's business in terms of revenues and operating profit. However, that division is now forecast to begin to decline in revenues because the public is looking for healthier options. MSUB has decided to sell its fast food operation and instead focus on selling to locally operated restaurants offering a healthier fare. Such restaurants will generally show lower revenue per unit but higher operating profit per unit. So because the fast food division is the largest component in terms of revenue and operating profit, the disposal represents a major strategic shift and will be reported as a discontinued operation. So this is what a discontinued operation is. So you think a certain segment is not performing well, you just simply close it down. Let's discuss something about discontinued operations in details. So what are discontinued operations in an income statement? We just saw discontinued operations are reported separately from continuing operations. Let me show you. Net of tax, and they may include any component or group of business that are going to be killed, that will not continue in the future. Let me show you. They are reported separately from income from continuing operation. Of course, this is after the net income, so you need to net income from continuing operations. So you need to report it on net of tax basis. This is an important point to be remembered. Then what may discontinued operations consist of? Well, they can consist of just like a division, maybe impairment losses, or maybe gains or losses from actual operations, and gains or losses on disposal. We'll discuss this with numbers as we proceed. And then it says, when are operations classified as discontinued? That's an interesting question. Normally, operations are classified as discontinued when a component or a group of component has been disposed, or maybe they are held for sale. Either they have been disposed or they are held for sale. Then it says what conditions must be present for operations to be reported in discontinued operations. Yes, there are certain conditions to be met. So for this, operations that you're discontinuing, you're leaving off, they must represent a strategic shift that will significantly affect your business operations, and it will significantly affect your financial results, right? So it could be a major business line or a major geographic area. So this discontinuance will have a significant effect on your financial results. It will have a significant effect on your strategy. It's a major strategic shift. So these are a couple of conditions to be present. What triggers the reporting of cost in discontinued operation? Costs are recognized when obligations to others exist. When we discontinue a segment, it may involve laying off some staff. Some people will have to be made redundant. So when you lay them off, you need to pay them something. So let us assume that we are going to lay off a few staff members because of this discontinued segment, and it might require employee severance pay. You need to pay them legally because they are being dismissed. 50,000, and then there's some contract termination fee, just for short, contract termination fee, $30,000. So this 80,000, these obligations in total 80,000 need to be recognized immediately as costs related to discontinuation. So this is the cost we were talking about. This cost needs to be recognized. This total cost relating to discontinuation of the business needs to be recognized in your financial statement when we decide to discontinue a segment. Further on discontinued operations, some computations. What types of items are included in the results of discontinued operation? Well, the results include operations of the component, any gain or loss on disposal of that component, or impairment losses with any subsequent changes in the fair value. We'll discuss as we proceed. It says, how are the initial and subsequent impairment losses treated? Alright, let's take an example. Let us suppose a company decides to discontinue its electronic division due to some strategic realignment. So we have some financial details to make this decision. We have the carrying value of the division, or the carrying amount. I will simply write CV, carrying amount of the division, that is about let's say $1 million. And the fair value less any cost to sell initially. Fair value minus any cost to sell is, let's say, $800,000, right? So then there are three types of items to be reported. First, it might have continued operating from 1st of January 2025 to maybe 30th of June 2025, let's say. So the result of these 6 months. So this needs to, this operating result, normal operating result of this electronic division up to the point of disposal. This is the first part, result of operations. Second, the gain or loss on disposal. When you will sell these assets, so either there is going to be a gain or a loss on disposal. Let us assume that we dispose of this segment for $750,000. So the carrying value was 1 million. We are disposing it off at 750. So this clearly shows that there is a loss. And the third component we will discuss in detail further, the impairment loss and any subsequent fair value adjustments. Given the initial fair value is less than the carrying amount. What was our initial fair value? Less cost to sell, it was $800,000. So let us suppose that after a few months, the fair value of the division increases to 850. This is the point we are discussing. What happens with subsequent increase in fair value? So if the fair value increases to 850 due to improved market conditions, what would we do? Since there was an initial loss of $200,000 and the fair value has now increased by $50,000. So what this will do, this 50,000 gain, 800 versus 850, this 50,000 gain will partially offset the impairment loss. Next question says, when are results reported for discontinued operations? Well, results are reported in discontinued operations during the period the component is either disposed of, you kill it off, or you decide to classify it as held for resale. I'll discuss it as we proceed. Then it says, how do we treat depreciation and amortization after discontinued operation? Please note, once a decision is made to dispose of a component, it is no longer depreciated, it is no longer amortized. For example, if a building part is being discontinued and it was previously depreciated for, let's say, $20,000, this depreciation stops once you have decided to dispose of this segment. Then it says, how is a component classified as held for sale measured? Let us discuss this. This is a bit technical. Okay, let's say we have a component we want to sell. So, and we have decided it to, for timing, to keep it as held for sale, let's say. So a component that is held for sale is measured at either its carrying amount or fair value minus cost to sell. Cost to sell. Cost to sell means cost needed to complete the sale. Right? So let's say the carrying amount is $300,000. Fair value, let's say, is $280, and cost to sell is 10. So that means it's $270. So 300 is the carrying amount, 270 is the fair value minus cost to sell. So the fair value clearly is minus cost to sell is lower than the carrying amount. So this is what we are going to use as the measurement value for this segment. Then it says, how should the result of a discontinued operation be presented in financial statements? Let me show you. This is it. This is it. The result of discontinued operations, net of tax, is reported as a separate component of income, and it has to be distinct from income from continuing operation. Then the question says, where should a gain or loss on disposal of a discontinued operation be disclosed? A gain or a loss on disposal should be disclosed either directly on the face of income statement I showed you, or in the notes to financial statements. Suppose in the previous example we were discussing, our carrying amount was 300,000, fair value minus cost to sell was 270, right? What happened? We sold it at 260. So this was the amount that we were reporting. Sale proceed 260. The difference, $10,000, is the loss on disposal. So this loss is shown separately on the income statement under the discontinued operation, or it may be reported in the notes to financial statement. We just discussed this a little while ago. So here we have a very good example of discontinued operations. The trial balance below presents the income statement accounts for year 1 from all sports companies' trial balance. The golf division of all sports has been losing money on a monthly basis. The golf division income statement accounts are also presented below. The board of directors decides on 30th April year 1 to dispose of the golf division. Why? Because it is losing money. The carrying value of the gold division on April 30th year 1 is $4 million, and its fair value less cost to sell is $2.2 million. Clearly there is apparently a loss of $1.8 million. After a month of negotiations, the division's net assets are sold on June 30th year 2, next year, for $2 million. The golf division has continuing losses in year 2 for $200,000 per month. All sports income tax rate is 40% for year 1 and 2. Assume that all sports income from continuing operations 4.875 in year 1 and 5.2 in year 2. So what we have been given, all the incomes and expenses are related to all components, and golf division has been given separately. These are the sales revenues and all these expenses, and this is the impairment loss. Why? Because the fair value was 2.2 million and the carrying value is 4 million. So the difference between these two is reported here as 1.8 million impairment loss. So how should the disposal of the golf division be reported on all sports companies year 1 and year 2 financial statement? Let me show you. So this is your income statement presentation year 1. You are going to show your income from continuing operations. This is already given. Let me show you. 4.875 million in year 1. So then we need to report our discontinued operations. How they are calculated? You take loss from operations of discontinued component net of tax for the period, for the whole year, of course. So I'll show you how this is calculated. You take sales revenue of golf division and deduct all these expenses: freight out, commission, advertisement, insurance, salaries, depreciation. So what you get is, you get a loss figure, and that is 2.4 million, right? So we need to report this on after tax basis. So 1 minus 40% give you the after tax figure, and it is 1.44 million, and that is what is shown right there. This is it. You can calculate it yourself. Pause the video, do the computation and match the number. Then loss from impairment of discontinued operation net of tax. Let me show how it's calculated. This is it. This is the carrying value, and this is the fair value minus cost of sales. So clearly there is a loss of 1.8 million, which is already reported here as well, shown here, 1.8 million. We need to take it on after tax basis. So you simply take 1.8 million multiplied with 1 minus 40%. This will give you the after tax figure, and that is $1.08 million. This is what is reported. And then you get the net income for the period. What about the reporting for year 2? In year 2, discontinued operation would include continuing losses, and let me show you what was the monthly loss. See, this is it. The golf division has continuing losses in year 2 of 200,000 per month. So since it was disposed of at the end of your second year in the month of June, so it's going to be 200,000 times 6. So that's $1.2 million loss. Take it on after tax basis by multiplying it with 1 minus 40%, and that's you get the number. So 1.2 million after tax, 1.2 into 60%, that's what you get. And where did you get this number from? It's given already. This is it. This is given right here. This was the figure for the year 1 and 5.2 million in year 2. Now we need to show what is the figure of loss from sale. This is it. Remember, this is what we wrote down our investment to 2.2 million, and it was sold on 30th June for $2 million. So clearly there is again a loss of $200,000. So this loss again needs to be reported on after tax basis by multiplying with 1 minus 40%. So that will give you 120. So that is the figure you will see there. Loss from sale of discontinued operation net of tax, and that's the figure of net income for year 2. Next we have foreign currency transactions. It says, what are foreign currency transactions gains and losses? Foreign currency transactions gains and losses happen when a company trades with a foreign company, any other company that it doesn't own. It's not my company. Let's say I am a company X. I trade with the company Y in a foreign country. I don't own that company Y. So such transactions, such trade result in foreign currency transactions. So what happens? For instance, if a US company buys goods from a German company and the transaction is in euros, so what happens? Any change in euro to dollar exchange rate by the time they pay could lead to a gain and loss. Let us discuss this with the help of an example. So please note, this gain and loss is not always at the settlement date. The gain and loss would also be recognized on every balance sheet date. Let me show you. Altino company purchased goods on credit on this date for 100,000 pesos. Olinto company paid for goods on 1st of February. The exchange rates were this when the transactions were entered into. Prepare the journal entries related to this foreign currency transaction. So when this transaction occurred, 100,000 times 0.1, that is $10,000, right? This is the exchange rate. I will tell you how this calculation is done as we proceed. So this is the entry you're going to make. Purchase is debit, and you're going to credit accounts payable. On which date? On 1st of December, year 1. Then what happened on the balance sheet date? The exchange rate varies. Now this same liability recorded for $10,000 is now worth only $8,000, 100,000 pesos times 0.08. So this clearly shows that your liability that was reported at 10, now it has value of only 8. So you need to reduce your liabilities. You're then going to debit your accounts payable and credit the foreign exchange transaction gain. That goes to the income statement. So this difference between the original recorded liability and the value of liability in the balance sheet rate goes to your net income. Now what happens on the settlement date? On the settlement date, rate again changes. Now the liability which you have booked on $8,000 needs to be settled at 100,000 times 0.09 at $9,000. So this time you're going to credit your cash with 9,000. You're going to debit your accounts payable with 8, but because that was the carrying amount, the differential is now the transaction loss this time. It's foreign exchange transaction loss, and it goes to the income statement of the next year. This goes as income statement item as a gain last year, 31st December year 1, and this is the loss for the next year financial statement. Are all transactions with foreign companies considered foreign currency transactions? No. Transactions between a parent company and its subsidiary in a foreign country that are meant for long-term financing are not counted as foreign currency transactions. For example, let's say we have a US parent P Incorporated. This P Incorporated, a US parent company, loans money to its UK subsidiary as subsidiary incorporated in UK, and the loan was made in dollars. So this is not considered as a foreign currency transaction, right? Next, what does the exchange rate mean? Simple. The exchange rate is the price of one currency in terms of another. And then there are two methods you can use for exchange rate. One is called the direct method, short for DM. Other is called the indirect method. Let me explain the idea. Direct method shows you how much foreign currency can you buy with 1 unit of your currency. For example, if you have $1 US, with $1 US you can get 0.85 euros. So that is the direct method. Your currency, $1, gets you 0.85 euros. This is the direct method. In the indirect method, it's just the same but in the opposite direction. That is how much of your currency can be bought with 1 unit of foreign currency. For instance, if now you have €1, how many dollars can you buy? €1 buys you $1.17. It's in the reverse order. So $1 gets you 0.85 euros, and you simply take 0.85 to the other side of the equation. Just write it this way. It's very simple. It's not an exact science. $1 US is worth 0.85 euros, and that means €1 is equal to 1 over 0.85 dollars, and if you simplify it is $1.17. As simple as that. So this is the direct method and this is the indirect method, and it's quite handy in computations. The next question is, what is the current exchange rate? The current exchange rate, often referred to as the spot rate, it is the rate for immediate delivery of a currency. For example, just like the example we were discussing a little while ago, $1 US gets you 0.85 euros right now. This is for immediate delivery. If you give $1, this is what you get right now. That's what you call the current exchange rate. Then you have, how are assets and liabilities from foreign transactions valued? Well, assets and liabilities from foreign currency transactions are recorded in the books of account using the exchange rate that was present at the date of transaction. For example, if a US company buys machinery from Italy for let's say 10,000 euros, and at that date the rate was $1.5 per euro, right? That means the transaction that you're going to record in the books is for $11,000. Just multiply 10,000 with 1.15, you get 11,500. So basically 10,000 euros is equal to $11,500. So this is the amount you're going to record your transaction. What happens if the exchange rate changes by the time the transaction is settled? This is what happens. When you originally recorded a liability for $10,000, because of favorable exchange rate movement, there was a gain on the balance sheet. Remember, the gain and loss is recognized at two levels. First, when the accounts are closed at the end of the year, there is a gain. But when the liability is settled, or let's say if you have to receive a foreign currency, when you receive foreign currency, there could be a gain and loss at the settlement date also. So on the balance sheet date, there was a gain, and then on the settlement date, there was a loss. So remember, this is how we bring gains and losses related to foreign currency transactions. So please link this question with the example we did a little while ago. How are foreign currency transactions treated on the balance sheet if not settled by the date of the financial statement? This very question has just been answered here. If the transaction isn't settled on the balance sheet date, so on the balance sheet date, we will take the date prevalent on the balance sheet date, and this rate adjustment will either result in a foreign currency transaction or foreign exchange transaction gain or loss. So remember, I told you there are going to be two instances of gain and loss, one on the balance sheet date and on the settlement date. Then we have statement of comprehensive income. Okay, what is comprehensive income? Comprehensive income, basically it's the total change in equity for a period, and it consists of two components. One is the income statement and other is other comprehensive income. Let me show you what I mean. This is it, your net income and other comprehensive income. Together they are called comprehensive income. Let us discuss this idea further. What components make up comprehensive income? That's it. This is it. Comprehensive income includes your net income, that is the income from regular business operations, and then other comprehensive income. These are certain items that are not part of your net income, but they still affect your equity, like unrealized gain or losses on certain investments. We will discuss this as we go along. The question that we need to answer right now is that comprehensive income has two components, net income and the other comprehensive income. Let's assume that your net income for the period is, let's say, $100,000. And your other comprehensive income has a $20,000 figure. Let's say this represents any foreign currency translation adjustment. It is one of the components of other comprehensive income. So together, when you add these two, you get 120. That is net income plus other comprehensive income. This is called the comprehensive income. So comprehensive income is sum of these two. Then the next question is, what is net income? Now that's funny. Net income simply is the profit a company makes after all expenses, all taxes, and all costs when they are deducted from your revenue. So generally your net income is income from continuing operations plus the results from discontinued operations we discussed a little while ago. Then we have what items are included in other comprehensive income under the US GAAP. Okay, we will discuss this point further in detail, but just a quick overview. It includes certain pension related adjustments. We'll discuss this in the coming slides. Then it has some unrealized gains and losses on investments, available for sale debt securities, that we'll discuss again, and foreign currency items, adjustments for translation gain and loss. We'll discuss it as well, right? And then there are other elements. So let's say a company might report unrealized gain of $5,000 on available for sale debt securities, and then there is a $3,000 loss on foreign currency translation. So that means the net impact of other comprehensive income is $2,000, right? So these items I described, we'll discuss it further. Then the next LOS or the question says, what are unrealized gains and losses related to debt securities and hedges? Let me explain this idea. Let's say you have purchased an investment for $8,000. And on the balance sheet is the fair value of this investment, specifically the investment in debt securities. This is specifically relevant because there are other investments as well. Some investments are held till maturity, some are held for trading, but we're talking about those investments that are held, that are available for sale, debt securities. So they had a value of $8,000 when we purchased them during the period. On the balance sheet date, the fair value is $10,000. So this $2,000 is a gain. It's an unrealized gain, clearly. So gains and losses from the changes in the value of investments, they are reported as a part of other comprehensive income. Also, the change in values of any hedging arrangements. We'll discuss this as we go along. Next, we have what about foreign currency adjustments in the comprehensive income? I told you there are some components of other comprehensive income. Let's say we have a subsidiary in the UK, whose financial statements are reported in pounds, and we are a US parent. So we subsidiaries in the UK, and our parent is in the US, where clearly the reporting currency is dollar. So when these foreign operations, these foreign subsidiary financial statements are translated, any gain and losses resulting from this translation into the parent's financial statements, this gain and loss is reported as a part of other comprehensive income, right? So these gains and losses, they remain in the other comprehensive income until the foreign operation is sold or otherwise it is disposed of. And then the next question says, what does the reclassification adjustment in the context of comprehensive income? I deliberately kept this part to answer this question. What does the reclassification adjustment in the context of comprehensive income means? Let's say these investments available for sale, debt securities, had a cost of 8,000, but on the balance sheet date they had a fair value of 10,000. So this $2,000 gain, unrealized gain, goes in OCI when these investments are actually sold for a certain amount. Let's say they were sold for 13,000 in the next year. So what happens? Clearly there is a gain between this reported amount now and the disposal amount. And then there is also a gain laying in the other comprehensive income. This gain has to be reclassified to income statement. So you will report a total gain of 5,000. There is 3,000. That is between 10,000 and 13,000 difference, and the 2,000 gain was already available unrealized in OCI. That needs to be reclassified to income statement. That's what it says. What does reclassification adjustment means in the context of comprehensive income? This is an example. Then we have what is the accumulated other comprehensive income. Accumulated other comprehensive income, basically it's one of the components in the balance sheet. We have various components of equity, that is additional contributed capital, we have common stock, we have retained earnings, and in that set of equity accounts we have an account called the accumulated other comprehensive income. You may say that the accumulated other comprehensive income is similar to retained earning. Thing is that the items in the net income reported in retained earning and items of other comprehensive income during the period are reported as a part of accumulated other comprehensive income. So this is the key point. It is basically similar to retained earning because net income goes to retained earning, but the elements of OCI are accumulated here. Then comprehensive income financial statement reporting. What is the requirement for reporting comprehensive income in financial statements? Comprehensive income and its component, the other comprehensive income component, should be displayed with the same prominence as other financial statements in a full set of financial reports. Then, are all entities required to report other comprehensive income components? No. Non-profit entities or those companies that do not have any item of OCI to report, they don't need to report any component of OCI. Can comprehensive income be reported on per share basis? No. Comprehensive income should not be reported on a per share basis under the US GAAP. Then it says, how can comprehensive income be presented according to the US GAAP? Yes, there are two ways I will show you. One is the single statement approach and other is the two statement approach. And what is the single statement approach for reporting comprehensive income? Where a single statement approach has been adopted, you need to include both your net income and other comprehensive income in a single continuous statement. Let me show you. This is a single statement showing you the net income, and immediately after that you have the OCI components, and that's your statement of comprehensive income in a single go. All this in a single statement. Then what is the two statement approach for reporting comprehensive income? This is it. The two statement approach displays comprehensive income as a separate statement that immediately follows the net income or the income statement. This is the number for net income, and now this is a separate statement showing you the components of OCI. One important point to be remembered, that whether you are reporting in a single statement format or two statement format, they have to be together. Like in single statement, there's a one continuous statement, but in two statement approach, you need to display them in the single place, one followed by the other. Then we have some other reporting issues. It says, how can components of other comprehensive income be reported? There are two ways you can do this. One is the net of tax and other before tax. Let's say you have a gain of $1,000, unrealized gain on available for sale debt securities. And let's say if the tax rate is 30%, then you can report it on after tax basis. 1,000 after tax of 30%. Let's say if there is $1,000 gain After tax, it's 1,000 less 300, $700. And then the other way to put it is that you report gross $1,000 and then you display $300 of tax separately, right? So these are the two ways you can use. Where is the income tax expense or benefit on the other comprehensive income item is disclosed? There are two ways. Either you report them directly on the face of financial statement where these components are displayed, or in the notes to financial statements. What does interim period reporting entail for comprehensive income? During interim periods such as quarterly or semi-annual reporting, companies need to provide not only the basic net income figures but also a total for comprehensive income. Then the next question says, what must all formats disclose regarding other comprehensive income? First, tax effects, tax effect of each component, then changes in accumulated balances of each component, then the total, this is first, second and third, the total accumulated other comprehensive income must be shown as a part of the statement of changes in equity. We'll discuss as we proceed in the next lecture. And fourth, reclassification adjustments. Detail of reclassification needs to be given. Then the next question says, where can changes in accumulated balances of comprehensive income components be shown? They can be shown either on the face of financial statements or in the notes to financial statements. Then it says, what are reclassification adjustments and why are they necessary? We discussed this a little while ago. Reclassification adjustments are necessary to avoid double counting of gains and losses. So they basically adjust for any items which was previously reported in OCI, and now that has to be reclassified to the income statement. We discussed a little while ago that if there is a gain on any security that you have sold, available for sale security, so any gain and loss related to this available for sale security, which is a part of other comprehensive income, now it needs to be reclassified to net income or your income statement. Then it says, how should significant reclassified items be disclosed? Any item which were component of OCI, they are now reclassified to income statement. What should we do with these? So significant items that are reclassified out of OCI, they must be disclosed on the face of statement where net income is presented, or as a separate disclosure in the notes to accounts. Then the last question says, can amounts of other comprehensive income components be presented before tax or after or net of tax? That we have already discussed this. This is the item we have already discussed, that they can either be presented on net of tax basis, or you can split the amounts into the figures and their tax impact.